So this happened a few days ago. The largest IPO this century has been halted. Is this the end of the world? Well, not quite. The Chinese stock market has more than 5,000 listed companies within them. And so there's no shortage of great companies to invest in. And here are 5 unique tech companies you might want to consider apart from Ant Group. Hi guys, Stanley here. Ant Group was supposed to be the largest IPO this year. No. It was supposed to be the largest IPO ever. And the company was valued at more than 300 billion US dollars. And its IPO was oversubscribed by 872 times. And its pre-IPO selling price was rumored to have risen more than 50%. Yet all this hype collapsed like a house of cards when the Chinese regulator halted its IPO on the Shanghai Star Market just 2 days before its IPO. Now, investors are spooked, and all hundreds of billions of dollars that went into bidding for the IPO are now free capital with no stock to invest in. However, the Chinese stock market have more than 5,000 stocks, and many have as unique and impressive business model as Ant Group. So, here are 5 Chinese tech stocks that you want to consider even without an IPO. Number 1. Alibaba Group. Listed on both the New York Stock Exchange and Hong Kong Stock Exchange, Alibaba Group is the 33% shareholder of Ant Group. So Alibaba Group is the company for you to look at if you have been ultra optimistic about Ant. Alibaba has also been instrumental in transforming the economy of China and has helped millions of small businesses scale through its platform. Today, the company has 3 main segments of business, generating close to 550 billion renminbi over the past 12 months. The 3 segments are its core commerce, its cloud computing, and digital entertainment. Although its core commerce is still its main profit contributor, Ant Group is now its largest associate, contributing more than 3 billion renminbi last quarter. And this is about 6% of its profit during the quarter and is one of the fastest growing parts of Alibaba. Thus, if you're bullish on the Chinese economy, then Alibaba Group might be the company you want to consider. Next, number 2. Tencent Holding is listed on the Hong Kong Stock Exchange. When you talk about Chinese tech, you cannot ignore Tencent Holding. Deemed as the copycat company, Tencent has its hands across many industries in China. It has the largest gaming business in China and is the top social media company with its WeChat and QQ platforms. However, apart from that, it is in the business of App Store, mobile security, mobile browser, video streaming, news, music streaming, online literature, online payment, and cloud computing. On top of that, it has a sizable investment arm, having invested in more than 800 companies. And out of that, more than 160 of them are now considered unicorn, companies that have value of more than 1 billion US dollars. Tencent is a way for you to gain exposure to the entire Chinese tech industry as it continues to be a key shaper of the industry going forward. So if you're optimistic about Chinese tech, Tencent is the one to look at. Next, number 3. Meituan Dianping is also a company listed on the Hong Kong Stock Exchange. In the beginning, there are 3 big tech companies in China, the BAT, Baidu, Alibaba, and Tencent. Now, in the new mobile era, another 3 giants has emerged, and they are the TMD, Toutiao, the company behind ByteDance, Meituan Dianping, and Didi. Meituan is the winner of the 1000 Groupon War. Back in 2010, the Chinese internet was moving through a trend of group buying, and Meituan started out as a copycat version of Groupon. However, it was not the only one jumping onto the Groupon trend at the moment. Even large tech firms like Alibaba and Tencent have their own version of group buying sites. At its peak, more than 5,000 companies were competing in this space, and after years of chaotic battle, Meituan merged with Dianping to become the leader in this field. So today, Meituan Dianping generates most of its revenue from 3 segments: food delivery, in-store hotel and travel, and the others. Its most profitable business is its in-store hotel and travel segment. Although this segment was impacted during the pandemic, its growth in food delivery helped to offset the drop. And with the reopening of China after the pandemic, and the rest of the world still continue to be in lockdown mode, the domestic tourism might see a huge recovery over the next few years, benefiting Meituan Dianping. Thus, this is definitely a stock to watch. Next, number 4. JD.com is a stock listed both on the Nasdaq and Hong Kong Stock Exchange. Although considered as the second player in the e-commerce space in China, JD.com has a very different business model than Alibaba. Alibaba Group focuses on being the software platform of choice for a third-party retailer looking to sell their products online. However, JD.com is a retailer by itself, so it is buying and selling products directly to the customer. In fact, it is the largest retailer in China, generating about 83 billion in sales in 2019. And that is half of the revenue of Amazon. JD.com is also investing heavily on a nationwide distribution network, having more than 750 warehouses and has the ability to deliver to almost every single corner in China. And for the first half of 2020, it continued to grow with its revenue reaching 347 billion RMB, up 28% from a year ago. The company has also turned profitable back in 2019 and is en route to grow its profit and free cash flow going forward. If you're bullish on online retailing in China, JD.com is a stock you cannot ignore. And lastly, number 5, Xiaomi Corporation is a stock listed on the Hong Kong Stock Exchange. Although all the previous 4 companies are wonderful tech companies in China, none of them is trying to build a strong brand like Xiaomi. Xiaomi is the only hardware tech company in this group. The company is very focused on building high quality products with affordable pricing. And with that strategy, it has won about 11% of the market share in the global smartphone industry. Today, it is more and more focused on the Internet of Things industry, which is projected to grow to 4 times bigger than the smartphone industry by the year 2025. Today, Xiaomi generates its revenue from 3 segments: smartphone, IoT, and internet services. Xiaomi is following the business model of Apple, trying to create a software ecosystem with its hardware. And by focusing more on serving the mass market, Xiaomi has reached a revenue of more than 200 billion renminbi within a decade of its founding. It has also turned profitable back in 2019 and looks set to have a profit of more than 12 billion renminbi this year. Among the 5 companies in this list, Xiaomi is the most international of the lot, having about 45% of its revenue coming from overseas. So with the winning strategy of its smartphone business and the rising demand for IoT globally, Xiaomi still has a long growth potential ahead of it. So there you have it, 5 key tech leaders in its field and some of the most innovative companies in China right now. So if you are rather disappointed with the suspension of Ant Group IPO, try to cheer up. China has no lack of great tech companies in its stock market. And we must remember one very important point when we're investing. For investors like ourselves, it is never the lack of opportunity in the market that is restricting us. It is always our lack of capital. So choose wisely, and there's no need to feel disappointed when the hottest IPO of all time was cancelled. After all, it is just one stock in the ocean of stocks for us to choose from. As always, till we meet again, my name is Stanley. Invest safely. With smart